Most people think debit means money going out, and credit means money coming in. But in accounting, that's completely wrong. And honestly, this is the exact point where most people start hating accounting. Students memorize rules without understanding them. Business owners get confused by bookkeeping. And almost everyone struggles with debits and credits at first. But here's the good news. Debits and credits are actually very simple, once someone explains them properly. So in this video, you'll finally understand what debits and credits really mean, why every transaction has two sides, and the easiest trick to remember everything forever. Let's make accounting finally make sense. If you've ever looked at an accounting textbook and felt like it was written in a completely different language, you're not alone. Debits and credits confuse almost everyone the first time. And most explanations make it worse. They throw around terms like journal entries and ledgers before you even understand the basics. In this video, we're going to fix that, for good. By the end, you'll understand exactly what debits and credits are, why they exist, and how they work in real business situations, whether you're an accounting student or a small business owner trying to make sense of your books. Let's get into it. Before we define anything, let's answer the bigger question first. Why does accounting even use debits and credits? Every financial transaction has two sides. If you buy a laptop for $1,000 cash, your cash goes down, but you now own a laptop. Two things happened at once. If you take out a loan, your bank balance goes up, but you now owe that money back. Again, two things, simultaneously. Accounting needs to record both sides of every transaction. Every single time. This is called double entry accounting, and it has been the global standard for over 500 years. Debits and credits are the language used to record those two sides. One side is always a debit. The other is always a credit. And when recorded correctly, the books always balance. Debit means left. Credit means right. Here's where most people go wrong. In everyday life, when your bank account gets debited, money leaves. When it gets credited, money arrives. So people assume that's what these words mean in accounting too. But in accounting, that is not what they mean. Debit and credit are purely positional, left and right. Whether a debit increases or decreases an account depends entirely on what type of account you're looking at. So let's cover the 5 account types, because this is the real key. Every account in every business falls into one of 5 categories. Number 1, assets. Things the business owns. Cash, equipment, inventory, accounts receivable. Number 2, liabilities. Things the business owes. Bank loans, unpaid supplier bills, credit card balances. Number 3, equity. The owner's stake in the business. What's left after subtracting liabilities from assets. Number 4, revenue. Income earned from the business's operations. Sales, fees, rent collected. Number 5, expenses. The costs of running the business. Rent paid, salaries, utilities, software subscriptions. Now here is the rule that ties everything together, and you need to memorize this. Assets and expenses increase with a debit, and decrease with a credit. Liabilities, equity, and revenue increase with a credit, and decrease with a debit. One more time. Assets and expenses go up with debits. Liabilities, equity, and revenue go up with credits. A memory trick, think of the word deal. Dividends, expenses, assets, losses. These all increase with debits. Everything else increases with credits. Once this is in your memory, the rest of accounting becomes much easier. Let's make this real with 4 everyday business examples. Example 1. You buy office supplies for $200 and pay cash. Supplies, an asset, goes up. Assets increase with a debit. Debit supplies $200. Cash, an asset, goes down. Assets decrease with a credit. Credit cash $200. Debit $200. Credit $200. Balanced. Example 2. A client pays you $1,000 for work completed. Cash goes up, debit cash $1,000. Revenue goes up, revenue increases with a credit. Credit service revenue $1,000. Balanced. Example 3. You take out a $5,000 business loan. Cash goes up, debit cash $5,000. Your loan payable, a liability, goes up. Liabilities increase with a credit. Credit loan payable $5,000. Balanced. Example 4. You pay $1,500 in office rent for the month. Rent expense goes up, expenses increase with a debit. Debit rent expense $1,500. Cash goes down, credit cash $1,500. Balanced. Every transaction, a debit and a credit. Every entry, perfectly balanced. This is the heartbeat of double entry accounting. Now let's talk about T accounts, because they make all of this visual. A T account is a simple drawing of one account, shaped like the letter T. The account name goes at the top. Debits go on the left. Credits go on the right. Let's build one for cash using our 4 examples. We debited cash $1,000 from the client payment, left side. We debited cash $5,000 from the loan, left side. Total debits to cash, $6,000. We credited cash $200 for supplies, right side. We credited cash $1,500 for rent, right side. Total credits to cash, $1,700. 6,000 minus 1,700 gives us a debit balance of $4,300. Cash has more coming in than going out, which makes sense for a healthy business. This is called the normal balance. Under normal conditions, assets carry debit balances. Liabilities and equity carry credit balances. Revenue carries a credit balance. Expenses carry debit balances. If an account ever shows a balance on the wrong side, that's a red flag. It usually means an error was made somewhere. Let's now connect all of this to something you've definitely heard of, the accounting equation. Assets equal liabilities plus equity. This equation is the foundation of the balance sheet, the financial statement that shows what a business owns and what it owes at any point in time. Every debit and credit entry you make must keep this equation in balance. Always. When you debit an asset and credit a liability, both sides of the equation grow equally. Balanced. When you debit an expense and credit cash, equity goes down because expenses reduce profit, and assets go down because cash decreases. Still balanced. This is why double-entry accounting is so powerful. It is mathematically self-checking. If your total debits don't equal your total credits across all accounts, you know immediately that an error exists. You find it and fix it before it causes bigger problems. Now you might be thinking, I use QuickBooks or Xero. The software handles all of this. Do I really need to understand debits and credits? Yes. Here's why. Software does exactly what you tell it to do. When you miscategorize a transaction, and this happens in almost every small business, the software records the wrong debit or credit without question. It won't warn you. Understanding debits and credits lets you catch those errors before they distort your financial statements. When your accountant hands you a profit and loss statement or a balance sheet, you'll actually understand what you're reading. You'll ask better questions. You'll make better decisions. And if your business ever applies for a bank loan or brings on an investor, you'll be expected to understand your own numbers. Knowing the basics of debits and credits gives you that confidence. Accounting is the language of business. And debits and credits are the grammar. You don't need to be an expert, but you do need to be literate. Let's bring everything together. Every transaction has two sides, a debit and a credit. They always balance. Debit means the left side. Credit means the right side. Not money in or out, just left and right. 5 account types: assets, liabilities, equity, revenue, expenses. Assets and expenses increase with debits, decrease with credits. Liabilities, equity, and revenue increase with credits, decrease with debits. T accounts show each account visually, debits on the left, credits on the right, balance is the difference. Normal balances, assets and expenses are normally debit. Liabilities, equity, and revenue are normally credit. The accounting equation, assets equal liabilities plus equity, must always stay in balance. And the rule that never changes, total debits must always equal total credits. Every single time. If you understand these principles, you understand the core of how accounting works. Everything else, financial statements, bank reconciliations, tax filings, is built on exactly what you just learned. If this video helped you, hit the like button. It helps this channel reach more people who need to understand their finances. Subscribe for more videos like this. We cover balance sheets, cash flow statements, financial ratios, and more, all explained simply, without the jargon. Drop any questions in the comments. I read all of them, and your question might become the next video. Thanks for watching Finance Hack Studio. See you in the next one.